I'm Emilie Aries, Bossed Up's founder and CEO, if we haven't had the pleasure of meeting yet, and I will be sticking around and helping Cris with our poll questions and presentation. So let me start by sharing my screen. And Cris, feel free to take it away.
Awesome. So the first thing, and I think Emilie's got a poll for you guys. I want to know about the tax refunds that you guys got so we know what we're talking about today. But our first question is, what do we do if we've got a tax refund? Like how many, what do we do with it? There's lots of things we can do with our tax refunds. I put together this word cloud for you guys, all the things I could think of. Well, what was I going to do if I got a tax refund? You know, do I spend it? Do I splurge? Do I sign up for Bossed Up Boot Camp? Do I give it to charity? What do I do? So tell us how much you got. Did you get a little bit? None? A big one? Because we're going to talk about sort of what to do.
And I'll give you 10 more seconds to fill out this poll, and then I will share those results so everybody can see them. If you haven't taken it yet, fire away. And I'm going to share these results now.
Okay. Good. So a little bit pretty evenly spread across the board. Good. Okay. Well, let's talk about what to do with your tax refund. So, you know, you can brainstorm a lot of ideas, but I like what I call the 80-20 rule. So can we go, is the next slide that, Emilie? Oh, no. So I like what I call the 80-20 rule. And the idea of that is that we should take 20% of any found money, gifts, tax refunds, bonuses, any money that you were not expecting and that is not part of your overall budget, you should think about applying this 80-20 rule. So take 20% of that money and do something fabulous. Do something fun, treat yourself, and take 80% and put it towards your goals, put it towards your debt payments. If you have credit card debts, if you have something that student loans that are bothering you, use 80% of that to do something to either pay off your debts or reach your goals. And 20% to do something fun and splurge with. This way, you're meeting your goals and you're not feeling deprived. You're not feeling like you can't splurge from time to time. But since it's really money that isn't part of your monthly budget, it's a great way to jumpstart or seed a new project or something you've been thinking you want to do for a really long time. Maybe it's something on your life list. Maybe it's something that's been bugging you that you just need to take care of, and you just only if you had a few extra $100. Go ahead and use that 80% to do that with, and take 20% and do something fabulous with it.
And where did the reasoning behind 80 and 20 come from? Because I feel like it is hard to see a big chunk of change come into your account and be like, only 20% is really for fun money. I mean, what is the reasoning behind that, do you think?
I mean, I've seen some people say 50-50. I feel like for me, the 80-20 comes really when we're talking about maybe bonuses, or, you know, when you start to think about $1,000, you can really treat yourself and feel good about something for $200. I mean, you can do something pretty fabulous with just $200 that you didn't think you were going to otherwise have. So even if you only have a found $1,000, you know, it's enough to make you feel satisfied with, you know, it triggers your brain to think like, this is satisfying. I've treated myself. I'm not just putting all that money towards something and I'm never going to see it, but 20% is usually enough. Even for smaller amounts of money, 20% is enough to sort of have that splurge where you're feeling like I've done something for myself. I feel good about how I'm using this money. and I've treated myself. So it's that little treat that you give yourself. Meanwhile, you're sustaining and moving forward in a really big way,
Yeah.
some sort of goal, whether it's paying down debt, building your emergency fund, funding a trip, funding, your Roth IRA, whatever it is, you're doing, things that satisfy your instant gratification needs, but that are also balancing and doing those long-term things that we want to be mindful of so that we can achieve those goals. Yeah.
I'd love to hear from the ladies who are tuned in today. Share with us what your 80% would go to. Just start off there. Share with us in the chat, what is it that you're paying down? Is it debt? What is it that you're investing long-term? That's not the fun money. That's not the treat yourself. Because I don't know about you, Cris, but I was raised in a household where money was always super tight.
Yeah.
And my parents lived paycheck to paycheck. And there was a real scarcity mindset that really drove anxiety and fear around a lot of financial conversations, pretty much all financial conversations. And, I'm thinking about my mom, who I love and respect and adore, but who really struggles, I think, with this martyrdom mindset. And she would take any kind of a refund and put 100% of it towards paying things down. And I've come to learn over the years that there are some significant marks in research around deprivation.
Yeah.
I want to flip the question and ask you, why is the 20% important? Why is it important to treat yourself and not put 100% of it down to like those big financial things we all should be doing?
Yeah. I mean, I think of it, food and money relate so closely together, and a lot of our behaviors and the way we can behave around both things can be similar. So I think of it sometimes as dieting, or anything, the gym, any all-in mentality can create this thing in our brains that makes us feel deprived, that makes us feel like we're not satisfied. And so then we make poor decisions where if we are constantly depriving ourselves, and if we are putting that money in a savings account and we're not treating ourselves, or we're paying down that debt, we move into that, we continue that scarcity mode, and we feel deprived. And so it eventually is going to lead to a splurge, whatever that splurge is in whatever area we're talking about, which is later going to make us feel bad about ourselves. Because we feel badly that we didn't make a smart decision, or we're going to feel badly that we spent all that money and we shouldn't have. And so by treating ourselves with that 20%, and it really can be any percent, it just whatever you decide that it is, making that conscious decision to say, I'm going to take X percent of this and do something for myself. Something fun. I'm going to do something that fills me up. I'm going to do something that satisfies me. I'm going to splurge. Maybe it feels decadent, whatever that is.
Yeah.
It creates that emotional response in our brain that makes us feel satiated and satisfied. So then we feel better about their decision, and it doesn't lead us to poor decisions down the line because we're in deprivation mode or we're feeling that scarcity.
I think the connection to food is so apt here, that metaphor. Anyone who's ever been on a very strict diet, striving for perfection, and then maybe slipped up at lunch and had that cheeseburger that you didn't quite plan on having, and then said, well, I guess I'll try again tomorrow. Might as well eat all the chips and all the fries and all the chocolate and the sundae and all. Anyone who's ever gone down that fun spiral of shame, really, and guilt that comes out of that knows that, satisfying your short-term needs helps you make better decisions over the long term. So I think that's such a great point. And I'd love to hear from our ladies, all of whom are putting that money into their savings.
I know.
What are you doing with the 20%? How are you treating yourself on the 20% side of things too? And while we're waiting for that to come in, feel free if you want to move along. But I am curious to see, what would people do to treat themselves and keep themselves satisfied?
Yeah. I know for us, it's always like a weekend away or a yummy dinner, even if it's just like one night at the beach, or a yummy fancy dinner that we wouldn't otherwise like go for, or I kind of have a thing for purses. But yeah, like we do the same thing in our house. Exercise gear or a trip. Yeah, that thing that that you kind of want, but you're like can't, justify spending the money on. We put it towards the house or the kids. Kids are big suckers of those kinds of things, which is awesome and fun. So good. So one of the things I want to talk about though is if you're consistently getting a refund that say, I don't know, I usually ballpark it somewhere like bigger than $1,000, depending on your particular situation. And I'm not a tax accountant, I'm not a CPA, so everything I sort of say from here on out is advice or general around taxes. But if you need really specific answers about your particular situation, you're really best off to talk to a CPA or another tax professional. But I can give you guys some general guidelines. So if you're getting a really big refund, I generally want people to make that money work harder for them throughout the year. We shouldn't give the government an interest-free loan for 12 months or longer, depending on when you file your taxes, when that money could be in your pocket every paycheck working harder for you. So if you're getting, I put here $1,500 or more a year on your taxes consistently. If you're single, you could probably lower that down to $1,000. But consider your withholdings. And so I just grabbed this image of the form off the IRS website. It's a very, very easy change to make. It's the W-4 form. You can get it from your HR if you're a W-2 employee. And this applies mostly to W-2 employees, because if you're self-employed, you have a whole nother tax system that you follow. So this is mostly for W-2 employees. But you can get this form on the irs.gov website. You just do a quick search for the W-4 or ask your HR person, and they'll give you this form. And what this form does is it tells them how much to withhold from your paycheck. And if you are getting too much, or if you have to owe, if you were somebody who had to write a check to the IRS this year, maybe you want them to withhold a little more. If you got a big refund, have them withhold a little less. Get that money in your paycheck every 2 weeks or every month and get it working for you. So if you get $1,000 or $1,200 or $1,500 a year back in a tax refund, you could have $60 to $100 more in your paycheck every month to add to savings, to put into your Roth IRA, or to put into your IRA, or to put into some other goal play, your house fund, or something else that you're saving for. So don't wait for it. Get it back. The other thing I made notes of is when you should change your withholdings. If you're expecting your filing status to change during the year, don't wait. So like me, for example, I'm getting married in October, and I know that I'm getting married in October, and I knew that in January. So my partner and I both changed our W-2 withholdings in January so that our tax filing status, our tax withholding status for the whole year was going to be married, rather than only waiting till we got married to make that change and having to do it at the end of the year and only having 2 months of withholdings at that new status. So things like divorces, having babies, getting married, if you're one day in the calendar year, it counts for the whole tax year. So if you know that you're expanding your family now, go ahead and change your withholding now. You don't have to wait until that event happens. If you're getting married, if you're getting divorced, if you're having a baby, if you're going to buy a house, those are the big ones that you would want to adjust up or down on your tax withholdings. And again, that changes how much you get in your paycheck. If you take on additional income, I know a lot of bosses have side hustles. So if you have a side hustle and you're getting a small 1099 income, go ahead and have that withholding just held from your paycheck, rather than having to deal with extra withholdings or making those extra quarterly payments. If you're making a substantial amount of 1099 income, you want to set up and make those quarterly payments. But if it's intermittent and it's small, you can just cover that with some extra withholdings out of your W-2. If you have a part-time job and you don't think they're holding enough, you can change that from your like main job. But definitely you're in control of how much money you get in your paycheck. If you've got questions, the IRS has a calculator, so you can go onto the IRS website. You can fill in this form electronically, and it'll ask you a bunch of questions about how many kids you have, and if you have a house, and if you're married, and it'll make suggestions for withholdings for you. So the other thing is, if you haven't changed your withholdings, say you've been in a job for a long time and you've gotten promotions or you've changed job and your income's gone up significantly and you haven't revisited that, I definitely recommend that you take a look at this particular form. So.
Question for you on that front.
Yeah.
And maybe, don't go here if I'm preempting you, but I love this idea that you want to make sure you're hitting the nail on the head when it comes to predicting your tax obligation, right?
Yeah.
Having to cough up a big chunk of change on tax day is no fun, but getting consistent returns that are great, feels like you're giving the government an interest-free loan that they didn't need. And maybe you could have made better use of that throughout the course of the year. What does that mean to put your money to work for you in a better way? Is it just having more room in your budget, or what's the best way to make the most of that?
Yeah, I mean, it really depends on how you're living. So for some people, that extra room in their budget means that maybe they're not putting stuff on a credit card that they can't pay off at the end of the month. For some people, it means that they can accelerate the payments that they're making to their savings for a goal, whether it's a house down payment or building their emergency fund or that dream trip they want to take, or finally jumping off that cliff from your side hustle being your full-time job and having that emergency net to catch you. It really depends on what your personal situation is, but I am all about having all your money as you earn it and not waiting. And I feel like smart women who are making smart decisions about their money shouldn't have to wait. Like, a lot of people are like, well, it's for savings and I like it and I like getting that money at the end of the year. But it's your money and you really should be in control of it, and you really should have it throughout the year. And if it's forced savings, then, figure out how to make that savings stick a little bit better throughout the year, maybe by revisiting your budget, revisiting your spending plan, and that kind of stuff. So I just think it's important that we have our money as we earn it.
Great point. Let's see how many of our ladies here in this second poll are consistently getting a similarly sized refund. Is this something that happens every year? And if so, this advice is going to be really applicable to you. So let's see. We've got a couple folks who voted. Give them a few more seconds. We've got a poll that is currently launched. It should be on the front of your screen, so go ahead and weigh in. This is an easy yes or no. Do you typically get a similarly sized refund each year? One more voter. 5, 4, 3, 2. All right. So judging by our results, a vast majority of folks on the call today have seen a refund like this year after year.
Yeah, so if you're getting that refund every year and it's, you're comfortable with it and it's more than $1,000 or more than $1,500, definitely go to the IRS website, plug in your details into that calculator, and go to your HR and get some of that money back throughout the year. Smart. So one of the things I wanted to highlight when Emilie and I put this together was we're hearing a lot of stuff about the new tax laws. And so I know some of this was, what do we do with our tax refund? But some of it also is planning for next year, because some of you guys might even see bigger refunds this time next year. So I put together some really quick high-level bullet points of things that people are hearing in the media about the new tax law that went into effect right at the end of the 2017 calendar year, so that we can sort of move forward. Individuals are going to see the standard deduction rise to $12,000. So right there, right now it's at $6,500 per person. So if you are single and don't own a home, your standard deduction is going to go from $6,500 to $12,000. So right there, that is more credit. So, when you go to file your taxes, it asks you what you've earned, and then it gives you like a standard deduction that you get to take on your taxes, and it is doubled, which generally means that if you make no other changes, you will get a larger refund next year, or this calendar year that we're in when you go to file your taxes this time next year. It rises to $18,000 for heads of household and $24,000 for married couples. So in each case, it is either double or slightly more than that. In partnership with that, tax brackets have dropped. So in February, you probably saw a little bit of a bump in your paycheck. Also another great opportunity to what I call sort of not be part of the fishbowl. So the idea is that goldfish grow as big as the tanks that they're in, and we can spend the same way if we're not mindful. So when you see that extra, some people told me they saw as much as $60. Some people said they saw $200 increase per paycheck. Great opportunity to capture that money. Look at your last paycheck before the tax change. Look at your new paycheck after the tax change. Take the difference and put it towards your goals. Pay down the credit cards, put it in savings, add it to the goal. Great way to do that pretty painlessly. Add it to your Roth IRA. It is a pretty painless way to increase your savings, and that should have happened around February. So if everything's on autopilot, you might want to go back and look at your paychecks and see where that change was and how much it was, and see if you can capture that. Because the tax brackets generally dropped, so the amount that you were withholding should have gone down. That paired with this increase in standard deduction probably means that you might get a larger refund next year. So be thinking that through. For people who own homes and do itemize their deduction, this was pretty hot here in DC at the end of the calendar year. State and local taxes are being capped at $10,000 per year, which in most places around the country isn't going to be a very big deal. But here in DC, other urban places where we pay a lot in property taxes and deduct that on our taxes, some people are being capped out on that. So you may not get to itemize the full deduction of your state taxes or your property taxes if the sum is more than $10,000. So there's a limit there. But again, the increase in the standard deduction should make up for some of that. Because of and this I think is something that a lot of bosses are going to have questions about. And so we can certainly stop and talk about this for a minute. Because of the increase in standard deductions, many filers won't itemize, which means charitable contributions won't be deducted. I can see your face, Emily. Do you want to stop and chat about that for a minute?
I missed that one in the past. I somehow missed that, and I was paying special attention to how this impacts small business owners, which you're going to get to next.
Yeah.
But my goodness, that's such a disincentive for nonprofit contributions.
It is. So if you are someone who's whose total deduction, so people who itemize their taxes, have deductions that are greater than the standard deduction. So in the past, that's been just about anybody who owns a home, and people who have lots of business expenses or unreimbursed business expenses. But with the increase to $12,000, fewer people are going to itemize. And that was the general goal in doing this, is that fewer people made it to simplify. But what it means is that unless you're itemizing on your taxes, the charitable contributions that you make won't be tax deductible. If you do itemize, they can go in that. So if you're over the $12,000 deduction, they still count. But because of that, most people won't meet that cap, and your deductions won't qualify. My opinion is it doesn't mean we stop giving, because we can do a lot of good with our dollars, and it's important that we make those charitable contributions, but I just don't want people to be surprised by that when it comes to the end of the year. And a lot of people are still saying your tax deductible contribution, which is true, if you qualify, it is deductible, but many more people aren't going to qualify. Unreimbursed work-related expenses are no longer allowed as an itemized deduction at all. So if you are paying things out of pocket at work, and with the idea that you're just keeping all those receipts, it doesn't matter if you itemize or not. If you're over that standard deduction, you still are not going to be allowed to use unreimbursed work expenses as a deduction. So for some people, that might be a big deal and something to perhaps go and talk to your HR and use that as a negotiation point around your salary, around your benefits. Put your boss tools on and go talk to somebody about that if you're not going to be able to deduct those this year. The only thing that did get continued on that, teachers can continue to deduct up to $250 a year for school supplies and materials, which I think is absolutely nothing, but it continues to exist. The other thing, and this is where your bossed up negotiation skills really are going to matter, is the ability to deduct moving expenses due to a relocation for a job are no longer allowed. So if you are considering moving for a job in 2018, or between now and 2018 and 2025, which is when these provisions are expected to expire, negotiate a relocation package, because you cannot deduct those expenses on your taxes anymore. So I think that as we talk in 2018 at boot camp and we talk about negotiation, it's going to be super important that we talk about negotiating that relocation package, and making sure that we get a bonus or a bump, or that they cover it, because they're still getting the taxes, we don't. No. Yeah, so let's talk about what didn't change really quickly. Teachers can still deduct $250 a year in materials. We talked about that. You may still be eligible to get a tax credit for an electric car. Adoption credits remain the same, and student interest deduction remains the same, remains unchanged. So those are the big pieces on the taxes. Yeah, any questions about that? Or
now would be a good time. So for folks who have any questions on what's been covered so far, fire away in the chat section. This is a valuable opportunity to take advantage of Chris's wide-ranging areas of expertise in helping you save your money. And then we can really I think we can open it up to questions that haven't been addressed today too.
Yeah, of course.
So definitely seeing that folks are thinking about that 80-20 rule, which is good, of saving, and then also some strategic splurging, not uncontrolled, but strategic splurging.
Yes.
And I guess my question is, we talk a lot at boot camps brunch, because at the Sunday morning brunch of every boot camp weekend, we feature a finance expert like Cris, who's served in this capacity many a time. We talk about different ways to save. So, let's say you're a professional woman who's considering asking for more, negotiating, who's doing all that stuff. What should she be doing with a little extra? How can she make the most of that little extra at this time of year? And what kind of savings vehicles should she be thinking about?
Yeah. So if her emergency fund is topped up, which I like to think of as about 3 months worth of expenses, then move towards maximizing your Roth IRA. So if you still qualify for a Roth IRA, maximize that. If you don't qualify for a Roth IRA, there are ways to get money into a Roth IRA, and the decreased tax brackets are a perfect opportunity to get money into a Roth IRA, especially if you don't qualify. So that if you don't qualify, that's where you might come and talk to somebody like me and put that strategy in place. But if you do qualify, that is the next best thing you can do for yourself, is fully fund a Roth IRA. The limit for 2018 continues to be $5,500 a year for people under the age of 50. And really quickly, it's money that you save after tax, and it grows tax-free. So in retirement, when you take that money, the only money you ever pay taxes on was the money you put in. As it grows and grows over the next 60 or more years, it is completely tax-free. So it is a very, very small tax amount that you pay on that money. Unlike your employer plan, which is pre-tax, and you have to pay ordinary income taxes on every dollar you take out. Roth IRA is a really smart way to save. And once you've done that, go back and increase the amount that maybe you're putting in your 401k, or start working towards another goal that you have. Maybe that's a house, maybe that's saving so that you can leave your full-time job. But it's really going to be unique depending on that. And again, that's all prefaced off of the fact that you aren't carrying any credit card debt. So if you're carrying credit card debt, use that to pay that off absolutely first. Student loans, not so much, but if you're carrying credit card debt, use that cash to pay that off first.
Awesome. And I do want to give folks a chance. So this is your chance to ask questions in chat before we wrap things up here. But I guess my last question is really about debt management.
Yeah.
You know, whenever we get any extra padding in our budgets, if we are managing some debt, mortgage, student loan debt, consumer debt on credit cards, like how should one go about strategically prioritizing getting rid of that debt?
Yeah, consumer debt first, because it's not leveraged by something. So my general opinion is that our student loan debt is what gives us the lives we have. It gives us the careers that we have. It has something behind it. Our mortgages have our homes, so there's equity attached to that, and there's an asset attached to that. Consumer loan debt, we're just borrowing from our future. So we're just paying ourselves back for money we've already spent, and can really slow us down. So wiping out that credit card debt, wiping out consumer debt. And then from there, I think it really depends. If you want to move towards having less debt, moving towards that really depends on interest rates, and it depends on a few other things. So maybe chatting somebody like me is a good way to then tackle that if you want to move on past that, but definitely get that credit card debt.
Awesome. Awesome. Well, that gives us a lot to think about in terms of what to do with a refund from Uncle Sam, how to make the most of it, and prioritizing getting out of debt, savings, and then treating yourself a little bit. So I think that's one area we can always brainstorm more on. So we're not martyring ourselves. And I think the Bossed Up community is a good place to help think about how we can strategically splurge in a way that is responsible and not guilt-inducing.
Yeah.
So let's continue this conversation, folks. I will be in your inbox very soon with an email with a link to replay this webinar if there's anything you missed today. In that email, I'll also include a link where you can connect with Cris, and she can really talk more one-on-one with you all about your personal financial situation, how you can make the most of your unique opportunities and goals and prioritize savings for them. And I'm always here as a resource to you in navigating career transition, career change. So let's keep in touch. I'm on all the things social media wise in terms of at Emilie Aries and at BossedUp.org. And we're bringing our fan favorite Bossed Up Bootcamp weekend, where Cris has been a featured finance trainer many a time, to New York City next. I'll actually be in New York City next weekend. We have just a handful of spots left. So if you are interested in joining us, my special tax day gift to you is a 20% off opportunity if you use this code in the next 24 hours to join us in New York, or really at any Bossed Up Bootcamp training weekend this year. So if you use this code TAXDAY, the capitalization does not matter, so you might as well just use lower caps. The TAXDAY, no space, no caps, you'll save 20% off of a Bossed Up Bootcamp weekend for women who are navigating career transition. Cris, is there anything else that our ladies should know about how to keep up with you?
You can find me on Facebook. Both my business page is on Facebook. You can always just Google me, Cris Caruso, and financial advisor, and you can find me here in DC. I would happily chat with any of you guys. If you're on this webinar and you want to have a one-on-one conversation with me, I'm happy to have a 30-minute conversation with you about your particular circumstances. Just reach out to me in that link that Emily's going to send out, and schedule a time, or reach out to me and we can schedule a time to chat about how we can, boss up your finances and make that tax refund and all of your money work harder for you.
And me and Brad the Boo finally signed up ourselves. As I've been saying to Chris, will make a priority for years now. I'm actually taking Chris up on her generous offer later this week and encourage you to do the same. I'll be in your inboxes. Thanks again for tuning in. You can find the replay there. If there are any questions that we didn't get to today, don't hesitate to email me back and I can connect you with Chris as well. Thank you so much for being here, Chris. I really appreciate it.
You're welcome. Thank you for having me.
Everybody have an amazing rest of your day. Keep bossing, and I will be in your inboxes real soon. Take care, y'all.